Activity ratios. Activity ratios measure how effectively a business uses its operating assets and convert them into cash or revenues. Activity ratios help in evaluating operating efficiency of business by analyzing fixed assets, inventories, and accounts receivable, etc. Activity ratios express not only financial health of business enterprise but also indicate the utilization of the balance sheet components. The term activity ratios is also known as efficiency ratios. An improvement in the ratios depicts improved profitability. So activity and profitability both are very much linked. This table contains some numbers. These numbers are used in our examples. Let us see. Accounts receivable turnover ratio, ARTR, is equal to credit sales divided by average gross accounts receivable. So, accounts receivable average 55,000 and credit sales for the period end 550,000. So, 550,000 divided by 55,000 is equal to 10. Days sales outstanding, DSO. Days here, number of days of a year used as 365. Some institutes consider this as 360 days per year, but we consider here 365 days per year. So 365 divided by ARTR. So 365 divided by 10 equal to 36.5. Noted down here, DSO is equal to 36.5 days. This formula is direct, so we can use other formula also. 365 divided by 1 times reverse this ratio or fraction. Average gross accounts receivable divided by credit sales. That is equal to 365 divided by 1 times 55,000 divided by 550,000 is equal to 36.5. Answer is same in both cases. So note it down here. Accounts payable turnover ratio APTR is equal to credit purchases divided by average accounts payable. So APTR equal to 220,000 divided by 22,000 average accounts payable and credit purchases is equal to 10. So days purchases outstanding. Here also we can use either formula 365 days divided by APTR or 365 divided by 1 times average accounts payable by credit purchases. In either case, 365 by 10 directly or 365 divided by 1 times 22,000 divided by 220,000. So either formula gives the answer 36.5 days. So note it down here, days purchases outstanding 36.5 days. Inventory turnover ratio ITR is equal to cost of goods sold divided by average inventory. So average inventory 33,000 and cost of goods sold 330,000. 330,000 divided by 33,000 is equal to 10. So inventory turnover ratio ITR is equal to 10. So days inventory outstanding. Here 365 divided by ITR or 365 divided by 1 times average inventory by cost of goods sold. Either formula gives the same answer, 365 by 10, 365 divided by ITR 10, or 365 divided by 1 times 33,000 divided by 330,000 equal to 36.5. Noted down here. So we got three answers like days sales outstanding, days purchases outstanding, days inventory outstanding. Now operating cycle. Operating cycle is equal to days sales outstanding plus days inventory outstanding. 36.5 days in both cases. So highlighted in yellow here, 36.5 plus 36.5 is equal to 73 days. Now cash cycle is equal to operating cycle minus days purchases outstanding. Here operating cycle answer is 73 days. So 73 days minus days purchases outstanding 36.5, the balance is 36.5. This is cash cycle. Total assets turnover ratio TATR is equal to sales or revenues divided by average total assets. Sales 825,000, cash sales plus credit sales together. Sorry. Divided by average total assets 165,000 is equal to 5. Total assets turnover ratio is equal to 5. Fixed assets turnover ratio FATR, sales or revenues divided by average net fixed assets. So 825,000 is common. Average net fixed assets 65,000. Fixed assets means plant, property, equipment, etc. So that is 825,000 divided by 65,000 equal to 12.69. Now let's recall what we have learned so far. Accounts receivable turnover ratio ARTR is equal to credit sales divided by average gross accounts receivable. Days sales outstanding is equal to 365 divided by ARTR, means accounts receivable turnover ratio, or 365 times average gross accounts receivable divided by credit sales. Reverse this fraction. Okay. Next, accounts payable turnover ratio APTR is equal to credit purchases divided by average accounts payable. Days purchases outstanding DPO is equal to 365 divided by APTR, or 365 times, reverse this fraction, average accounts payable divided by credit purchases. Sorry. Inventory turnover ratio ITR is equal to cost of goods sold divided by average inventory. Inventory outstanding days, or days inventory outstanding, is equal to 365 divided by ITR, or 365 times average inventory divided by cost of goods sold. Reverse this fraction. Cash cycle is equal to operating cycle minus days purchases outstanding. Operating cycle is equal to days sales outstanding plus days inventory outstanding, DSO plus DIO. Total assets turnover ratio is equal to sales divided by average total assets. Fixed assets turnover ratio is equal to sales divided by average net fixed assets.